Assalamu alaikum. So on this video lecture, we will be discussing all about capital structure and leverage. Okay, so as a recap, we have already known that our WACC, or the weighted average cost of capital, is derived by summing up the weighted cost of capital. So we have here, for example, the debt. We have the weight of the debt and the cost of the debt multiplied by the after-tax. So we have here the after-tax cost of debt and the weight of the debt. So we have the after-tax cost of debt here and the weight of the debt. Then we just add the preferred stock, the weight of the preferred stock and the cost of the preferred stock, plus the weight of the common stock plus its cost multiplied by its cost of common stock. So this is our WACC, or the weighted average cost of capital. In our previous lesson in capital budgeting, we usually encounter the phrase target capital structure. So we have the target capital structure as preferred by the management, like 30% for debt, 40% for preferred, and another 30% for common stock. So that is a target capital structure. So now in this lecture, we'll be discussing about what is really the optimal capital structure. So we have here our target capital structure. This is our plan on which we wanted to raise our capital. So this is the mix of our debt, our preferred stock, and common equity. On the other hand, our optimal capital structure, this is the firm's capital structure that maximizes our stock price. So again, take note, we have the maximized stock price, not earnings per share, not anything else. It is the stock price. Okay, so we have here, when we set our capital structure, this involves a trade-off between a risk and return. So we know that debt is the cheapest source of capital, but using more debt will raise the risk borne by our stockholders. But as what we know, when we use more debt, it actually increases the expected return on equity. Because if you imagine, if you have only 100,000 capital, and then the income of that 100,000 is 10,000, so you get 10 over 100, and that is 10%. But if you have other extra capital, and that would boost up your profit. So let's say you have a capital of the same total capital of 100,000, but only 50,000 of it is your own money. 50,000 of which is from debt. So if you still have net income of 10,000, your return on equity would be 10 divided by 50, and that will become much more higher than 10 over 100. So in that scenario, when we use debt, it generally increases our return on equity. So we have here the relationship between the debt, the stock price, and our expected return on equity. The higher risk associated that comes together with more debt, this tends to lower the stock price. Why lower the stock price? Because investors can see that your debt ratio is increasing, and that would mean a higher risk for stockholders. So therefore, the bid for the stock price will be lower stock prices. But the higher risk of this debt is also met with higher expected return on equity, as I have discussed. So therefore, in the optimal capital structure, we try to find the capital structure that strikes a balance between risk and return in order to maximize our stock price. So there are four primary factors that influence our capital structure decision. Number one, business risk. What is business risk? Business risk is the risk borne by the business that stems primarily from the business operations and assuming that the firm has no debt. So that is business risk. Number two, we have the firm's tax position. Okay, so it is the tax rate, the corporate tax rate. Number three, we have the financial flexibility. Okay, because capital structure decisions are tend to affect long term. So that's why financial flexibility is needed to meet short-term financing and also to finance long-term financing. And we have number four, managerial conservatism or aggressiveness. Because if management is really conservative, then it would tend to avoid debt because it is more risky. But if the manager is more aggressive, they tend to employ debt because they see the potential of earning higher return. Okay, so when we hear operating leverage, that means that um, there is a high percentage in our total cost that is composed by the fixed cost. So if there's a high composition of our fixed cost than variable cost, we are said to be having a high degree of operating leverage. So, as what we know, leverage, like what we already know no, in physics, it implies the use of a lever to raise a heavy object with a small force. So, just like in politics, no, if people have leverage, no, our smallest word or action can accomplish actually a great deal. But in business terminology, when we say a high degree of operating leverage, this means that a very small change in our sales would result to a very large change in our returns on equity. So we have here a example, no? Plan A and Plan B, no? We compare here the different degrees of operating leverage. Plan A, as what you can see, we have our very small fixed cost lang of 25,000. So here, the firm does not have automated equipment. So our depreciation, our maintenance, our taxes, and other expenses would be low. So our total operating cost here is composed actually of just minimal lang of fixed cost. So in Plan B, it calls for a higher level of fixed cost. Okay, so we have here fixed cost of 70,000. So the firm uses automated equipment here. So for example, we have um, depreciation, higher cost of depreciation and others. So let's look at the break-even quantity. So we have discussed a while ago what is the operating break-even. So operating break-even is simply the fixed cost divided by the contribution margin. Okay, so because sales price per unit less variable cost per unit is equal to our contribution margin. So when we compare here, we have here our fixed cost in Plan A of 25,000. We have contribution margin of 0.50. So therefore, our break-even in units is 50,000. For Plan B, we have fixed cost of 70,000 divided by our contribution margin, and that would be 1, 2 minus 1. So we have 70,000. So how does operating leverage affect business risk? So if we put other things constant, a higher operating leverage of the firm, the higher the business risk. Okay, the higher the business risk. Okay, so if as you can see here, if we have a high operating leverage, like in Plan B, the higher the business risk, because you need to meet 70,000 units just to break even. But if the operations be smooth, it will generate more profit. So let's continue. Okay, so as what we can observe here in these two graphs here, Plan A has a steeper slope, right? Its slope, it means that variable cost per unit can be higher than they would be if the firm would have more operating leverage as compared here in Plan B. Okay, so our break-even point in Plan B occurs at 70,000 units, while in Plan A, it's only at 50,000 units. Okay, so as you can see here, Plan B is leveraged. It can have more profit, but it can also be subjected to higher risk for losses. Okay, so from this point onwards, let's be guided by this example of Big B. Okay, so here at Big B, we have different debt amount borrowed and different debt assets ratio and different interest rates. So we have here 20,000 denomination per borrowing. And for example, if Big B will borrow 20,000 funds, the cost of the interest rate would be 8%. If Big B would borrow 120,000, the interest rate would be 15%. So of course, the higher the amount of the loan or the borrowing, the higher the interest rate. Why? Because the borrower or the um, lending, the one who lends would always compensate the risk borne by putting higher interest rates on the borrowing. Okay, so we have here the Big B's data when it is financed with zero debt. So it will totally not borrow, it will not totally loan, no? So the debt would be 0%. So here we assume that the company has chosen Plan B, no? We use the automated equipment. Okay, so EBIT are not affected by the financing decision. So the same EBIT will be the same, having the same EBIT. Okay, so as what we can see here, our debt ratio is 0%. We have the same assets, 200,000, and our equity, 200,000. Shares outstanding of 10,000. So as you can see here, we have the probability distribution of our demand. So our EBIT here is actually the expected value of this probability distribution. So we have here the return on equity. We have return on equity here expected of 14.82% if we employ no debt. So we have expected value of 12% rather, 12% expected value. Okay, so we have our standard deviation of 14.82% and our coefficient of variation of 1.23. So for our earnings per share, okay, so this is our earnings per share, no, from the net income divided the net income available for shareholders divided by the shares outstanding. Okay, so we have here these amounts. Okay, so just take note of this. We will compare this when the company would add debt of 50%. Okay, so again, we have here the assumption. What if we will add debt? So from zero debt, we will add 50%. Okay, so we have here our assets, 200,000. We have the debt of 100,000, 50% of the assets, 100,000. We put the interest rate as what is given in the previous slide. 100,000 would cost us interest rate of 12%. Okay, so we have here equity of 100,000, and that would become, our shares outstanding would now become 5,000, because the assumption here is we'll be borrowing so that we can buy back some shares. Okay, so again, buying back of shares will be discussed in another topic. What is the rationale behind, and so on and so forth. So as you can see here, our probability of distribution. Okay, so our EBIT is not affected. That is the assumption. So we have here the interest rates. It is not, again, it will not become zero because we have now applied for a loan. Okay, so we have here our net income. We have the return on equity. Okay, so by the way, I just want to clarify in case you have forgotten your stock knowledge, baka hindi na stock yung stock knowledge ninyo. Again, we have here the three terms. We have expected value. We can see it's 16.80%. Standard deviation, 29.64%. And coefficient of variation of 1.76. So again, when we are the stockholders, we want to see expected value because that is our returns. So we want this expected value to be higher as possible. The higher, the better. Again, standard deviation, this is the risk that these projections would differ from the actual earnings. So we look this is standard deviation here, this is the risk. Okay, so as the risk, of course, we want this to be lower. And the irony of an investor is we want high return, but we do not want high risk. Which is ironic because if you really want to have high return, then high return means higher risk. But an ordinary investor would generally want high return and low risk. Okay, so that being the case, we have here the coefficient of variation. So coefficient of variation is the best criterion if we wanted to compare investments of differing returns and differing risk, like what we have shown in a while ago. If the company has no debt, the expected value is something from 9% something, okay, and the standard deviation is lesser. Okay, so if in plan A that is lower risk, but in plan B this is higher return, right? The expected value is much higher than plan in no debt, in zero debt. So what we want to see here is the coefficient of variation, because coefficient of variation is incorporates the standard deviation and the return. No? If you remember, our coefficient of variation has the formula. We have standard deviation divided by the expected value. That is our coefficient of variation. So generally, what this coefficient of variation tells us that this is the risk per unit of return. So this is the risk per unit of return. So therefore, the lower our coefficient of variation, the lower the risk, then the better it is. Okay, so if we evaluate the first plan of having zero debt, hindi mag-utang, okay, kung titingnan mo yung standard deviation, if you are the risk factor na titingnan mo, you would go for zero utang. Of course, it is no risk. But if the investor wants high return, you would like to see the expected value. The higher, the better. So if we have if we apply for a loan, let's say 50% of the total asset would be debt, that would increase our return on equity, right? Okay, but it also increases our risk. So we will look at the coefficient of variation, and this coefficient of variation will become our metric. So we will compare 1.76. Okay, so as what we can see in the previous slides, there should be a trade-off between risk and return because you cannot just say that we will add debt because it will increase our return on equity. Yes, you are true, but you are partially correct because you did not factor in the risk. Okay, so there should be a trade-off. So now we want to get what is the optimal capital structure. So of course, 50% actually is not automatically the optimal debt level, no? Okay, so we will discuss that in a while. So, optimal capital structure, this is the firm's capital structure that maximizes our stock price and generally calls for a debt ratio that is lower than the one that maximizes expected earnings per share. Okay, so for short, we are looking for a debt ratio that is maximizing the stock price, and that debt ratio is not the debt ratio that would maximize our EPS. Please take note of that. Okay, so again, we know that when that stock prices are positively related to expected earnings, but negatively related to higher risk. So therefore, in our example a while ago, the extent that higher debt levels raise our expected earnings per share, our financial leverage works only to increase the stock price. However, as our debt levels increases, it also increases our risk. So it raises the cost of equity and therefore it works to reduce the stock price. So as you can see, even though we increase the debt capital ratio from, let's say, 0 to 50%, it raises our EPS, but the higher EPS is actually more than offset by the corresponding increase in our risk. Okay, so again, now our capital structure that maximizes the stock price is also the capital structure that minimizes our WACC. So please take note of that, as what we are looking for when we are looking for the optimal capital structure, that is the point, that is the structure that maximizes our stock price and at the same time minimizes our WACC. So since stock price is a very lengthy solution, lengthy calculation, accountants and managers alike are looking at the capital structure that minimizes our WACC. So since optimal capital structure maximizes stock price, minimizes WACC, so therefore other put it on a shorter analysis that the optimal capital structure, we will look at the optimal capital structure by looking at the capital mix that will give us the lowest WACC. Okay, so as what we can recall, no, if the firm has no preferred stock, the WACC, our WACC is just the debt and the equity. So we have here in this expression, no, the percentage of debt and equity. So therefore, we have the in the next slides onward, we are looking at the debt ratio and the debt capital ratio. Okay, so just take note of that. Okay, so here, this is just an example of the stock price and the WACC estimates at the different debt asset ratios. So of course, everything here is computed, no? So this is what is I think more tedious in capital structure is that you have lengthy solving, no? And dapat hindi ka nawawala sa analysis kasi pag nawala ka sa isang analysis, that factor would affect the next factor, and if you get it wrong, then all your solution for the next, all the rest of the figures will be automatically wrong, no? So that's why the job of financial analysts and the job of management accountants are very highly paid because of this very difficult solving, no? So dapat hindi ka nawawala. Okay? So, we have here the debt assets, the debt ratio, so 0%, 10, and whatsoever. So we have the debt equity. So we will just, I will just share this as a summary. Okay, but later on, we will compute one by one to get the optimal capital structure. Okay, so we have here the debt equity percent. Okay, so debt divided by equity. So here we have the debt divided by the assets. This is the debt ratio, and this is the debt equity ratio. Please take note, ha. As of this point, you should know clearly the difference between the debt ratio and the debt equity ratio. That is very basic, no, in our financial statement analysis. Okay, so we have here the debt ratio, 10, 0%, 10. Okay, so if you have a debt ratio of 0%, our debt equity would be 0. Okay, so if you have a debt asset of 10, so ibig sabihin, in the debt asset, 10% of the total asset is debt. So therefore, our equity for that asset is 90. So that's why you get 11.11%. No? So this is just an example. So we will get 10 divided by 90. So on and so forth. So for example, we have a debt ratio here of 20%. 20% means that the total assets, in total assets, we have 20% debt there. So therefore, if we compute for the debt equity ratio, if debt is 20%, then the remaining 80% of the capital is equity. So therefore, our debt equity would be 20 divided by 80, and that would give us 25%. So this is just the sample, no? So if you have, again, debt ratio of 30%, if you have a debt ratio of 30%, meaning 30% out of the 100%. So therefore, what remain of the 100%, the 70% is the equity. So our debt equity would be 30 divided by 70, and that would give us 42.86%. So on and so forth. Okay? So yan, patikim pa lang yan, no? Ng computation natin. So, what's very important here is dapat hindi ka nawawala sa analysis, because I repeat, if nawala ka sa analysis sa isa, then everything of the analysis would be wrong. Okay? So, yan. Mag-accountancy kayo para mag-stressful yung buhay niyo. Okay? So, we have here the after-tax cost for the debt. So, paano yan kinuha? Ewan ko, no? I-plus minus mo lang, no? So, no after-tax debt, no? So, simple lang. I-multiply lang natin, no? Yung interest rate at this particular level, di ba, binigay man yung interest. For example, 10%, 20,000 yung utangin, magkano yung interest cost, di ba? So, i-multiply mo lang yan siya sa after-tax rate. So, tax rate is given. So, just get the after-tax, so 1 minus tax rate, and multiply that with the interest rate. So, we will get the after-tax cost of our interest. Okay? So, we have here the expected EPS. So, again, ma'am, another computation ba yan? Yes, another computation ito, no? So, this will be discussed in a while, no? And estimated beta. Ma'am, kinocompute ba yan? Yes, of course, no? So, in our capital budgeting, in our previous lesson, we compute the cost of equity given the beta already. Okay? So, here, we'll be computing beta as it is. No? So, that makes capital structure more difficult, because the beta that we are, usually we are trained on, just it is part of the given, but in this topic, in capital structure, as we compute everything, we compute the beta. Okay, so if as you can see the beauty, no? So actually this is sa mga analytical minds, sa mga mahilig mag-solve, sa mga mahilig mag-puzzle. So this is actually parang wow factor, because parang this is just a very big puzzle that you need to solve from the different aspects of the company. Okay, so it will give us a clearer understanding na, pag ganito pala, ganito yung mangyayari. Kasi kinumpute natin yan, di ba? And then, this, if yan yung affected na naman yung isa, so on and so forth. So, we'll be computing the beta every time. This is not given. We will be the ones computing this. And the cost of equity will be affected by our beta. Okay, our beta is affected by the debt-equity ratio. Okay, so our beta will affect our cost of equity, and our cost of equity will affect the estimated price, and our price, as what we compute, will affect our price-earnings ratio. And we will compute the WACC, which is also affected by the different cost of equity here and the beta and the after-tax rate of the debts. Okay, so we will solve that in a while. Okay, now, so let's go to the sample computation for the WACC if we employ different debt assets ratios. Okay, so we have here the same assumption. If we borrow 20,000, our interest rate would be 8%. If we borrow 40,000, our interest would be 8.3%. If we borrow 120,000, our interest rate would be 15%. Okay, so our total assets would be 200,000. So therefore, if we borrow 20,000, our debt asset ratio, debt to assets would be 10% because 20 divided by 200 would be 10%, so on and so forth. Okay, so we have here the Hamada equation. Hamada equation is very important in determining capital structure. Okay, so the Hamada equation is used in determining the level of our beta. Okay, so our beta, according to Hamada, in his equation, the levered beta or the beta of the company when it employs debt, when it has leverage, we call that the levered beta is equal to the unlevered beta multiplied by 1 plus after-tax rate times the debt-equity ratio. So again, take note that we are using here the debt-equity ratio in the Hamada equation.